Tom Lee does it again.
You're doing exactly what I tell you not to do, Tom, and that is giving a price target and a time frame. 5,500 on the S&P by the end of June.
That's right.
Now, you can hate on Tom Lee. You can call him the perma bull. You can talk about his hair. But you can't take away the fact that this mother lover has been right about the market more often than anybody I can think of in recent history. While we have the Michael Burrys that predicted 27 crashes out of less zero, we have the Jim Cramers, we have all these crazy analysts running around, catching screen time. Tom Lee comes out about every once in a week and drops a prediction about where the market is headed. Now, he's not right 100% of the time, but he's right way more often than he's wrong. And his most recent prediction is something you have to listen to.
I think there's a fundamental case, Joe, which is inflation is coming in softer than expected. And I think the job market is it's cooling, but not weakening dramatically. And I think that's a good situation for equities. And I think that the sell-off in April actually hasn't really been fully recovered. And that's why we expected a rebound in May, but I think that carries over into June. And there's still $6 trillion in cash on the sidelines, and margin debt's still way below where it was in October 2021. So we know investors really aren't that long yet. So I think that comes together this month.
Now look, Tom Lee, the co-founder, the head of research at Fundstrat, is the same guy who told you in January of 2023, when everybody were bearish about the market, about the economy, about inflation, when the S&P 500 was at 3,800, Tom Lee comes out and he actually says, look, guys, I know it's going to be an unpopular opinion, but the market is going to end at 4,800 by the end of this year. So you can listen to me, you cannot listen to me. It's your choice, but I'm telling you exactly what's going to happen. Now, everybody called him the perma bull. They laughed at him. But guess what? The S&P 500 ended the year at 47.85. So for those who are betting against Tom, well, hold on a second. Now, his most recent prediction that just came out is absolutely insane. Now, it might sound like he's just talking about mundane stuff because all he said was, look, guys, the S&P 500 is going to run from 5,200 to 5,500 by the end of June. Just a 300-point run on the S&P 500. Who cares, right? Wrong. This is huge. Allow me to explain. He's talking about 4% in 3 weeks on the S&P 500. That's half, Eddie. Half of the annual return of the S&P 500 in just 3 weeks. Not to mention the fact that stocks like Palantir, stocks with high beta, a 3 and above beta, that means 12% in the next 3 weeks. Now, I don't know if he's right or wrong, but that's one hell of a prediction. Now, he was actually asked about his rationale.
What are you seeing in terms of components that make you confident that those were outliers that we saw a couple months ago, where it looked like it was inflation was coming back?
The April inflation data, both CPI and PCE, kind of revealed that the two things that the Fed's been waiting to cool are starting to cool. One is shelter inflation. It's decelerating, even though it's still higher than the Fed would like. And then I think there's some evidence that auto insurance, which has been rising over 22%, is beginning to sort of normalize. And I think sometime before the second half, auto insurance is no longer going to be contributing to inflation. So that's the dynamic we think that's at play.
And he explains it very, very simply. There's no other analyst out there that gives you clear, simple answers that you can go back and check and verify. None of this mumbo-jumbo amorphic stuff you can't really understand. And it says one simple thing. He said, look, guys, inflation is getting cooler. It's getting softer. Now, we have a stable job market. It's not collapsing. So what's happening right now is that we have the perfect setup. On the one hand, the economy is holding up. On the other hand, inflation speed is actually reducing. In every single historical case where the Federal Reserve actually cut rates, that was the critical factor. When the Fed cut rates because the economy started to crack, because something started to break, that didn't lead to economic spike. That didn't lead to a stock market spike. But when the Federal Reserve cut rates because inflation slowed down, while the market was okay, what you would call a soft landing. In that case, the rate cuts actually led to great performance on the economy side and consequently on the stock market side, because the stock market is always going to reflect the economy. They don't exist in separate universes. What he's saying here is like, we're going to get cuts in a good economy, decent economy, and lower inflation, which is the perfect setup to get a high boost from the stock market, because the stock market is going to price in the future. And in that scenario, all odds are pointing to the fact that we're going to have a great economic spike, and that's why the stock market is going to reflect that ahead of time. Now, he's also talking about the fact that there's $6 trillion parked in money market accounts. Now, this is money that went out of the market, at least part of it, anywhere from 1.2 trillion to 2.5 trillion, depends on who you ask. A portion of that 6 trillion is not supposed to be there. That's money that was supposed to go back into the stock market. But because it spiked so fast, a lot of these professional money managers are basically saying to themselves for the past 6 months, we're going to wait for a pullback. We're going to wait for a correction. This is just too expensive. We don't want to be suckers. We're going to wait till the market drops before we re-enter this. And as the market pushes up and up, as the market hits new all-time highs, as it's getting more and more hard for them to sit on the sideline and look at this, the time is ticking. And this is an important element to understand here. He's insinuating to this, but he's not fully explaining, but I will. You see, these professional money managers that are looking at this, they're getting paid by very wealthy individuals. And for these heavy hitters to miss out on a huge spike in the market and not be a part of the game, that's the equivalent of losing money. If you manage your money and you miss out on a huge market spike, that is the same for them as if you just lost them money. This is all about respect, honor, ego, and obviously, they like to make money. So as the clock ticks, as we're getting to the end of the year, closer and closer by every single day, the money managers are basically getting pressured. This is the second half of the year. They're still not back in the game. Now is the time for them to make the decision. Every single day that the time passes, more and more pressure will mount on them to put this money in play, especially as the market continues to fly higher. Now, he also talked about the fact that the Fed doesn't even have to cut rates for this to happen. As long as the Fed doesn't hike, as long as we remain at the current position, that's good enough because, over the past year, we had high rates, but earnings were stellar. The economy is doing fine. The job market is doing fine. For him, a cut is a bonus. One cut is great, 2 cuts is great, but it's not about that.
A lot of your calls are based on the Fed cutting. So you must think that the Fed is going to be able to cut. Is that because of inflation? Is it because the economy slows? Fundamentally, what do you think has to happen for all these bullish things in both stocks and crypto to happen with the Fed?
Yeah, I think it is important for the Fed to not have hikes on the table. So I think that's the most important for investors is the Fed is no longer in a rate hiking cycle. But if the Fed makes even just one cut this year, I think it's really supportive of equities because it really shows the Fed is trying to sort of nurture the business cycle, and it's a good environment for stocks. I don't think 1 cut or 3 cuts makes that much difference for stocks, but again, you're exactly right. It all depends on inflation. Really, the edge coming off enough for the Fed to say we're comfortable cutting this year. Companies' earnings have actually really spoken to how in a 5% pretty restrictive rate environment, earnings have been really robust. I know consumers, there are some trouble signs out there, but consumer leverage is still quite low. And of course, if the Fed does begin to cut, there's a lot of levers that will boost both consumer wealth and company demand. So I think there's still positive catalysts that are associated with a Fed cut eventually.
And he actually says, look, if we get 1 cut, that's good enough. We don't need all 3. If we get 1 cut, that's a signal that's going to jumpstart the whole process, especially the housing market. When everybody's sitting on the fence, nobody wants to move, the interest rates are just too high for people to buy and to sell because everybody's waiting for a move. Once that signal comes in from the Federal Reserve, once we get that first cut, the housing market will actually start moving, transactional activity will pick up, and the prices will drop consequently. The only thing that's keeping the housing market up right now is because we literally don't have any transactional activity. Everybody's waiting to see what the Fed will do. Once the rates just start to fall, just by 1 cut, this starts the whole process. And I completely agree with Tom Lee, especially if you look at the short-term indicators. Right now, on the Fear and Greed Index, we are in fear. We're not even neutral. Right now, we're not even overbought. So if you look at the market right now, we're literally floating in the middle. But obviously, he doesn't have a crystal ball, and neither do I, so nobody really knows about how this thing plays out. But for the smart investors that are trying to DCA their way into this complex market, this seems to be a logical path to start increasing your positions. Slowly DCA into the companies you believe in, into the companies you think are going to be long-term 5-year projects you want to be a part of. Now, we just made a few videos about NVIDIA and Salesforce and a bunch of other companies that will give you an insight into what companies to look at which prices. But if you actually want to get better at this, I invite you to join our academy at patreon.com/Tom Nash. And our academy will teach you how to evaluate companies, how to scout for companies, how to build your position, the whole theory from A to Z. And of course, join the Discord, discord.gg/Tom Nash. It is 100% free to join. You can join, become a member. You can upgrade later if you want, but to join is absolutely free. And obviously, we do have Stock MVP, which is my tool. I built this for you guys to evaluate companies within 30 seconds. Look at a company and know right away if it is a great company or trash you should stay away from. Stock-MVP.com. Check it out right now. Use the code TOM25 to get 25% off for your lifetime of use of Stock MVP. And you get 1 week for free to try it out before we charge you a single dime. Thank you so much. I'll see you in the next video.